is bet for a continuation of the current move, the current direction. We see a couple of divergences if we look toward the bottom of the graph. This is the volume line down here. This one just shows an average of volume over, 50 days? Yeah, 50 days. This is not as positive as the price trend because you have here, your greatest volume was here in the decline, and the positive volume, the best positive volume was here in the very beginning of the rally. Now, on a strong rally, ideally what you'd like to see would be volume continuing to grow as more and more people buy into the idea that this is going to be a successful long-term movement upward. That, in fact, is not what we're seeing. We're seeing, as you can see, this average line continues to decline as we go to the right. So that's a rally that, all else equal, the volume points say it's tiring a bit. What you also see, though it isn't quite as clear on the screen, you might see it better on your own sheet of paper there. The red lines, in general, are a little bit stronger or a little bit higher than the black lines, all else equal. That means that more volume tends to be coming in on the down days than on the up days, which again is not a confirming volume trend. The second divergence that you'd look at is here in this middle tranche here. You call these momentum lines without getting into any definitions. And normally what you want to see is that the momentum lines are at least roughly paralleling the price line. So here you have a obviously ascending price line, but you have a slightly descending momentum line. And when you see that type of divergence, more often than not, the momentum wins rather than the price. So you've got some positive items showing on this graph, and you've got some negative items showing on this graph. But demand is strong, and if you look to the next page, by the way, as you'll see through all of these things, what everybody would like, as would any technician in our business, would be everything lines up in the same path and we know what direction things are going to go next. You know, that's to be fondly desired. That isn't going to happen. That never happens. So what you're going to see is a lot of conflicting data as you see various studies, various criteria point to in different directions. And that's always the case. What we have to do in trying to evaluate this type of stuff, to the extent that it's in our process at all, which it is only minimally, is to discern which are the critical variables, and that's sometimes an art more than a science. But what I want you to see at least is the vast array of data that are available, any of which could be the critical variable. And that's where kind of the experience and the discerning eye comes in to help make that decision. And nobody makes it right all the time. I mean, that isn't going to happen. So you try to keep your percentage of errors low, and you try to keep the consequences of your errors even lower. In any case, demand is strong, supply is weak. Turn over, if you would, to the next page. Page 13 shows that breadth has been confirming this 12-month rally also. Short-term breadth is simply, it's measured a few different ways, but we're looking at it here in the middle by just the number of advancing stocks every day less the number of declining stocks every day. And then that number is added on to a cumulative average here. And you can see as prices have moved up here, so the advanced decline line has moved up here. And so that's what you want to see. You're seeing breadth confirm price movement here. So on a short-term basis, we're seeing everything good. On a longer-term basis, you're seeing an upward bias here on price. You're seeing a downward bias here on advanced decline. So a little divergence on the longer term, although it's confirming the short-term upside movement. And the bottom down here is new highs, new lows, and it is an overwhelming confirmation, but there's no divergence there at least. Good numbers of new highs, so that's at least confirming a positive price movement. The next couple of pages look at availability of liquidity. Money supply is low relative to market value. It's just a measure of how much more money is available to go into stocks. And what we're looking at here, you can see here, cash as measured by M2 compared to the asset value, the market value. And ideally, you'd like to see lots of cash relative to market value. In this instance, we see relatively low levels of cash relative to market value. And you can see here in the upper box, this is the least attractive of the three modes. There is not a lot of available cash to go into stocks relative to the size of the asset pool that the stock market represents. Another look at liquidity is on page 15. Money is leaving money market funds, which puts this measure also in its least bullish mode. You can look at here at the bottom. It shows that the money has been coming out of mutual funds at a fairly aggressive rate here recently. Something had to fuel the rally that we've seen. And you can look up in these boxes and see that when the observation is in this mode, it is the lowest of it's the least attractive for an investment market rising further. Another source of potential demand for stocks is seen over on the next graph, and that's short interest. Short interest, for those who don't play the game regularly, is the amount of stock that has been sold short. In other words, sold without having owned the stock before, which is really a bet that I'm selling it short and I want to buy it back hopefully when prices are lower. So you're selling stock that you hope to repurchase at a lower level. And this is a contrarian indicator. Clearly, when you sell something short, you're negative about the stock at least. Or if you can also sell short the entire markets, which means you'd be negative about the market itself. But it's looked upon as potentially bullish if there's large short interest, because when you think about it, everybody that's short eventually has to buy stock to cover that position, to neutralize that position. So it is existing potential demand when you see large short positions. And what this shows is that at least on the most recent readings, we have a relatively low level of shorts, which means there isn't quite as much potential future demand as you might otherwise hope to see on the bullish side. And you'll see again when you look up here into this box that it puts the performance potential in the lowest of the three modes. Page 17 shows that the Federal Reserve is doing its best to provide the fuel to keep the economy and the markets rallying. The Fed has primed the monetary pump, and it shows how strongly the Fed has grown the monetary base, compared to any time in the past quarter of a century, which is essentially the time scope of this graph. And clearly you've seen, of course, one of the things you have to look at with all of these graphs, and I'm not making a point to point it out because it would take us forever to go through some of these things, is up in here, this is like a 4-week smoothing. And you'll see on some of these others, it's 126-day smoothing, which is roughly half a year. A 252-day smoothing, which is a full year, essentially, business days. So what time period is used can often have considerable effect on the data themselves. In this instance, it happens to be 4-week smoothing. But you get the idea, because this is over 25 years. It's been wild compared to any time in the not too distant past, and we are